Greetings. Welcome to Simply Good Foods Company's fiscal second quarter 2021 conference call. At this time, all participants are in a listen-only mode. The question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. Please note this conference is being recorded. I'll now turn the conference over to Mark Flanagan, Vice President of Investor Relations. Mark, you may now begin.
Thank you, operator. Good morning. I am pleased to welcome you to the Simply Good Foods Company earnings call for the second quarter ended February 27th, 2021. Joe Scalzo, President and Chief Executive Officer, and Todd Comfort, Chief Financial Officer, will provide you with an overview of results, which will then be followed by a Q&A session. The company issued its earnings release this morning at approximately 7 a.m. Eastern Time. A copy of the release and accompanying presentation are available under the Investors section of the company's website at www.thesimplygoodfoodscompany.com. This call is being webcast, and an archive of today's remarks will also be available. During the course of today's call, management will make forward-looking statements that are subject to various risks and uncertainties that may cause actual results to differ materially. The company undertakes no obligation to update these statements based on subsequent events. A detailed listing of such risks and uncertainties can be found in today's press release and in the company's SEC filings. Note that on today's call, we will refer to certain non-GAAP financial measures that we believe will provide useful information for investors. Due to the company's asset-light, strong cash flow business model, we evaluate our performance on an adjusted basis as it relates to EBITDA and diluted EPS. We have included a detailed reconciliation from GAAP to adjusted items in today's press release. We believe these adjusted measures are a key indicator of the true underlying performance of the business. The presentation of this information is not intended to be considered in isolation or as a substitute for the financial information presented in accordance with GAAP. Please refer to today's press release for reconciliation of the non-GAAP financial measures to the most comparable measures prepared in accordance with GAAP. With that, I'll now turn the call over to Gerald Scalzo, President and Chief Executive Officer.
Thank you, Mark. Good morning, and thank you for joining us. Today, I'll recap Simply Good Foods' second quarter results and provide you with some details on the performance of our brands. Then Todd will discuss our financial results in a bit more detail, and we'll wrap it up with a discussion of our outlook before opening it up to your questions. Second quarter net sales increased 1.5%. Core ongoing net sales that exclude the impact of our Simply Protein divestiture and European business exit increased 2.7%, driven by continued e-commerce growth, Quest success in new forms, and solid international performance. As expected, trade promotion expense was greater than last year, supporting higher levels of in-store merchandising and display. Additionally, as discussed last quarter, Q2 shipments slightly lagged consumption as certain retailers adjusted back from a Q1 inventory build. Importantly, throughout the quarter, retailer support for the category and our brands remained strong. Adjusted EBITDA for the second quarter increased to 2.2%, primarily due to strong cost controls and Quest acquisition synergies. Total Simply Good Foods second quarter retail takeaway, including unmeasured channels, increased mid-single digits with IRI measured channel growth of 1.7%. Marketplace trends were similar to last quarter. Specifically, our performance was driven by the snackier portion of our portfolio, primarily confections, chips, and cookies that are consumed mostly at home. Bars for both brands remain temporarily soft in measured channels due to fewer on-the-go usage occasions. In the second quarter, we executed well against our priorities, driving sales and earnings growth in a challenging marketplace. We are well positioned over the remainder of the year and have initiatives in place that we believe will result in solid financial results. Consistent with the first quarter, total Simply Good Foods second quarter retail takeaway in measured channels outpaced the category across all time frames, driven primarily by the snackier portion of our portfolio. Importantly, the company gained market share, as did each of our brands in their respective subsegments of weight management and active nutrition. The active nutrition segment of the category, which includes Quest, increased mid-single digits. Quest POS outperformed the active nutrition segment, nearly 3-to-1 during the quarter. I would note that IRI Mueller C-Store universe represents about 70% of Quest total consumption. The weight management segment, which includes Atkins, remained soft in the second quarter and declined high single digits due to fewer on-the-go usage occasions. In the second quarter, Atkins continued to outpace the weight management category. While early, our marketplace trends in the third quarter are improving. Atkins' second quarter U.S. retail takeaway in measured and unmeasured channels declined low single digits. A solid e-commerce growth, about 10% of Atkins' U.S. sales, was offset by softness in traditional brick and mortar. Atkins' IRI, Mueller, and C-Store measured channel retail takeaway was off 5.7%, identical to the first quarter. Performance in December and January sequentially improved versus the first quarter, but February POS declined mid-single digits impacted by winter storm store closures. Importantly, retailer support in the quarter was solid, and in-store merchandising and display was greater than last year, supporting consumer seasonal participation. As expected, channel-informed trends were similar to the last few quarters. Atkins Confections momentum continued with POS growth of 14.3%, as these products are primarily consumed at home. Bars and shakes performance was similar to the first quarter, impacted by fewer on-the-go usage occasions. E-commerce growth continues to be a strength, with consumption up about 50% in the quarter. Bars, shakes, and confections all increased strong double digits, with shakes outperforming and representing about 50% of e-commerce sales in the quarter. We are pleased to see that buyer growth continued from the first quarter into the second, reflecting consumers' renewed interest in weight management as they begin to emerge from COVID-19 movement restrictions. We're encouraged that both growth in new buyers and loyalty among retained buyers tracks similarly to pre-COVID-19 benchmarks. Importantly, consumers are coming back to the brand and recognize the attributes and benefits of our products as a way to help them achieve their goals. Buy rate is a key metric impacting Atkins' return to pre-COVID-19 growth levels. Overall, buy rate was below prior year levels due to reduced consumption among bars and to a lesser degree shakes. Importantly, recent research indicates a high correlation over 0.8 between return to work and Atkins bar and shake consumption, reinforcing our belief that improving consumer mobility will positively impact brand consumption and buy rate. As we enter the third quarter, we would point to 4 key factors related to the Atkins brand. First, year-ago comparisons are easier as we lap last year's significant consumption declines from the early stages of COVID-19 lockdowns. Second, we're starting to see early signs of improvement in shopper traffic in measured channels, especially in the mass class of trade. Given Atkins' development in this channel, it should help both buyer growth and consumption. Third, effective marketing and new product innovation should enable us to continue to build on our year-to-date buyer trends. And the potential improvement in consumer mobility should help accelerate buy rate of bars and shakes. And lastly, we expect in-store merchandising and display will be greater than prior year's reduced levels as retailers anticipate consumer shopping and consumption habits will improve. Now let me turn to Quest, where second quarter retail takeaway increased 16% in the measured IRI Mueller C-Store universe. Importantly, trends improved across the major food, mass, and convenience channels. Similar to last few quarters, our performance was driven by snacks consumed at home. As we lapped the year-ago launch of ready-to-drink shakes, this headwind has been offset by improving bar performance and the launch of the Quest Peanut Butter Cup that's off to a good start. Quest bar performance sequentially improved and declined about 4% in the quarter versus 8% in the first quarter. This was significantly better than the bar segment that was off low double digits in the first half of the year. As I stated earlier, Quest e-commerce business continues to do well, with retailer takeaway up 60%. Our business at Amazon is strong. Chips more than doubled. Bars and cookies increased more than 50%. And confections momentum is building. In the second half of fiscal 2021, we anticipate that POS will continue to be strong and measured in e-commerce channels and in the third quarter and moderate a bit in the fourth as we lap strong comparisons in the year-ago period. Chips and confections momentum will continue and bar performance will improve. And similar to Atkins, in-store merchandising and display has been reinstated versus the prior year pullback as retailers anticipate consumer shopping and consumption habits will begin to recover. In summary, we're pleased with our second quarter results that were largely in line with our expectations. Retail takeaway was slightly better than expected, driven by solid e-commerce growth, as well as Quest performance in measured channels. The sequential improvement in nutritious snacking category trends over the last few quarters is encouraging, and the positive growth in Atkins buyers indicates weight management is becoming increasingly more relevant. Combined with easier year-ago comparisons and improving shopping traffic in measured channels, we expect solid growth in the second half of the fiscal year. Recall, our analysis indicates that as consumer mobility increases, it correlates to greater levels of consumption of our brands. Our fiscal third quarter is off to a fast start, and we're executing well against our plans and initiatives that should drive sales and earnings growth over the remainder of the year. Now I'll turn the call over to Todd to provide you with some greater financial detail.
Thank you, Joe, and good morning, everyone. I will begin with a review of our net sales. Total Simply Good Foods second quarter net sales increased 1.5%. The core North America and international net sales increase contributed 1% and 1.7% respectively to total company growth, while the Simply Protein brand divestiture and the European business exit were a combined 1.2% headwind. North America growth was driven by strong Quest volume performance in both measured and non-measured channels and modest declines in Atkins. Specifically, Atkins' solid e-commerce performance was offset by declines in measured channels, an increase of trade promotion expense due to higher levels of in-store merchandising versus the year-ago period, and the previously mentioned timing of shipments in the first quarter related to the seasonal retail inventory build, about a 2% headwind. Our core international business was a 1.7% benefit to sales growth, driven by gains in Australia for both Atkins and Quest. We anticipate that growth in this region will temper in the second half of the year as we lap these initiatives that began about 1 year ago. The divestiture of Simply Protein and the European business exit will be about a combined 1.5% headwind to full-year fiscal 21 net sales growth versus our previous estimate of 2%. Now for a review of second quarter results across other major metrics. Gross profit was $90.3 million, an increase of $4.9 million or 5.7% versus last year. Gross profit in the prior year was affected by a non-cash $5.1 million inventory purchase accounting step-up adjustment related to the Quest acquisition. Excluding the inventory step-up, gross profit was $90.5 million last year. This resulted in a Q2 gross margin decline of 70 basis points due to higher levels of in-store merchandising and unfavorable product form and channel mix. Productivity and Quest acquisition synergies offset modest supply chain inflation, primarily inbound freight to our distribution center. In the second half of fiscal year 2021, we expect slightly lower gross margin due to a return to typical retail in-store merchandising levels and modest inflationary impacts. The reduction of in-store activity in the year-ago period was due to lower shopper traffic related to COVID-19. Therefore, full-year fiscal 21 gross margin, apart from the inventory purchase accounting step-up in the year-ago period, is expected to be slightly lower compared to fiscal 2020. While input costs are not expected to be a meaningful headwind in fiscal 21, we are seeing some inflationary pressure as we examine our fiscal 2022 needs. Our strategy is to maintain and increase gross margin, and we are assessing the levers available to mitigate potential input cost inflation. Adjusted EBITDA, which excludes Quest integration costs, restructuring expenses, and stock-based compensation, increased 2.2% or $0.9 million to $42.6 million, primarily due to cost control measures and Quest acquisition synergies. Overall, SG&A expenses were in line with our estimates. Specifically, selling and marketing expense declined $0.7 million due to lower selling costs as a result of Quest synergies and the divestiture of the Simply Protein brand. And G&A expenses declined $0.4 million as integration synergies and cost control more than offset higher incentive compensation. Note that the company Q2 marketing expense was about the same as last year, primarily due to the elimination of investments in the Simply Protein brand. However, core North America and international marketing expense increased 8% versus last year. For the full year, the company continues to anticipate that marketing expense related to its core business will increase at least in line with organic sales growth. Moving to other items in the P&L, interest expense declined $2.6 million to $8 million due to the pay down of term loan debts. Our effective tax rate in the second quarter was 27.7%, about the same as last year. Net income in Q2 was $19.1 million versus $10.7 million in the year-ago period. Year-to-date results are as follows. Net sales increased $82.5 million, or 21.8%, to $461.8 million, driven primarily by the Quest acquisition. The Simply Protein divestiture and the European business exit were a combined 1.4% headwind. Gross profit was $184.3 million, an increase of $36.7 million, or 24.9%, driven by the Quest acquisition. Gross profit in the prior year was affected by a non-cash $7.4 million inventory purchase accounting step-up adjustment related to the Quest acquisition. Recall the non-cash inventory purchase accounting step-up was a 200 basis point headwind in the fiscal first half of 2020. Excluding this amount, gross profit was $155.1 million last year. This resulted in year-to-date gross margin decline of 100 basis points, driven by higher levels of in-store merchandising and the inclusion of a full 26 weeks of the slightly lower margin Quest business. Excluding Quest integration costs, restructuring expenses, and stock-based compensation, adjusted EBITDA increased 24.2% to $91.3 million, primarily due to the inclusion of 26 weeks of Quest results in the current year, as well as cost control measures and acquisition synergies. The increase in SG&A expenses were primarily driven by the inclusion of Quest. Specifically, selling and marketing expenses increased 13.3%, or $6 million, to $51.3 million. The majority of the increase was due to the addition of Quest. G&A expenses increased about 15%, or $5.5 million, again, primarily due to the inclusion of Quest. The net impact of interest income and interest expense was an increase of $2.3 million due to a full 6 months of the acquisition-related debt. Income tax expense was $15.7 million versus $2.2 million in the prior year. Year-to-date net income was $41.6 million versus $5.9 million last year. Turning to EPS, second quarter reported EPS was 19 cents per share diluted, compared with 11 cents per share diluted for the comparable period of 2020. In Q2 2021, depreciation and amortization expense and stock-based compensation was $7 million, about the same as the year-ago period. Costs associated with Quest restructuring were $2.2 million, $7.5 million lower versus last year. Adjusted diluted EPS, which excludes the items just mentioned, was 25 cents, an increase of 2 cents versus the year-ago period. Note that we calculated adjusted diluted EPS as adjusted EBITDA less interest income, interest expense, and income taxes. Year-to-date reported EPS was 41 cents versus 6 cents per share, primarily due to the inclusion of Quest, as well as lower acquisition and integration-related costs. Year-to-date, adjusted diluted EPS was 54 cents, an increase of 9 cents versus the year-ago period. Please refer to today's press release for an explanation and reconciliation of non-GAAP financial measures. Moving to the balance sheet and cash flow, in February 2021, the company paid down $25 million of its term loan debt and at the end of the second quarter, the outstanding principal balance was $556.5 million. Building on last quarter's cash flow from operations, in the second quarter, the company generated about $25 million of cash, resulting in $39.8 million of cash flow from operations in the first half of fiscal 2021. Note that the company typically generates higher levels of operating cash flow in the second half of the year versus the first half. As of February 27, 2021, the company had cash of $91.3 million, and the trailing 12-month net debt to adjusted EBITDA ratio was 2.7 times. Capital expenditures in the first half of the year were $0.4 million. We still expect $5 to $6 million of CapEx in fiscal 2021, driven primarily by equipment for our new warehouse. Our outlook this year for interest expense remains unchanged at approximately $30 million. I would now like to turn the call back to Joe for closing remarks.
Thanks, Todd. Our business continues to perform well despite the significant effects over the last year due to reduced consumer mobility related to COVID. In the second half of the year, we anticipate improving retail takeaway trends in our business driven by easier year-ago comparisons, improving shopper traffic in brick and mortar, especially the mass channel, and strong buyer growth on both our brands. Assuming consumer mobility in the United States remains at current levels and broad lockdowns are not reimposed, we anticipate full-year net sales of $930 to $940 million and adjusted EBITDA of $180 to $185 million. This includes a combined 1.5-point headwind to net sales growth related to the Simply Protein divestiture and our European business exit. As Todd mentioned earlier, given year-to-date gross margin performance, full-year fiscal 2021 gross margin is expected to be slightly lower than fiscal 2020. The company continues to anticipate adjusted EBITDA margin expansion as acquisition synergies and SG&A cost controls are expected to more than offset reinstated in-store merchandising, modest supply chain inflation, and higher incentive compensation. Additionally, the company anticipates 2021 adjusted diluted EPS to be in the range of $1.07 to $1.11 versus 91 cents in fiscal year 2020. The combination of Atkins and Quest provides us with two uniquely positioned brands that are aligned around the consumer megatrends of wellness snacking, convenience, and meal replacement. And consumer feedback indicates that these megatrends will become increasingly more relevant as consumers return to work, school, and more normal lives. We have an advantage asset-light variable business model that enables strong cash flow from operations and provides us with the financial flexibility to invest in organic growth opportunities and participate in M&A. We are confident in our growth prospects and are executing against our strategies that position us to deliver on our financial objectives with the ability to invest in the business as a path towards increasing shareholder value over time. We appreciate everyone's interest in our company, and we are now available to take your questions.
Thank you. We'll now be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants that are using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Thank you. Our first question is coming from the line of Jason English with Goldman Sachs. Please proceed with your questions.
Hey, good morning, folks. Thank you for letting me in.
Hey,
a couple of questions. Good morning. And I apologize if I missed this in prepared remarks, but can you tell us what the organic sales growth was for both the Atkins brand and Quest brands?
So for the quarter, you'll see in the queue, the Atkins was down about 10%, largely due to the shift from Q1. And also we had due to the storms in Texas, we had a fair amount of shipments, particularly on the Atkins brand, that kind of got held up in transit. That will come back in Q3. So versus, a low single digits total consumption, timing of shipments was off a bit on Atkins. Quest, on the other hand, was up in the high teens.
Okay. And I think I heard, Todd, you mention in prepared remarks that pull into Q1 out of Q2 was about 2 points on Atkins. Okay, so implying that this deferral of shipments into Q3 may actually be like an 8 point or larger type benefit for Atkins. Am I doing the math properly on that?
Yes, it's probably not that much. We also pulled back with our new business model in Canada. That affected the North America business for Atkins as well. So we lost a point or two there. So we lost a few points due to the storms. That will go right into Q3. And then we lost a little bit in Canada as well.
Got it. That's helpful. And Joe, quick question for clarification on the outlook. In prepared remarks, you mentioned that your guidance is predicated on the current consumer mobility levels sort of holding steady rather than sequentially improving. But at the same time, right before that, you mentioned you expect mobility to continue to improve. So I guess the question is, which is it? You think, from your planning assumption, are you assuming stagnation on mobility, or are you indeed expecting and planning for continued progress?
Yeah, we're actually the assumptions in our guidance for the second half of the year assumes status quo.
Excellent. Thank you so much for the clarification. I'll pass it on.
Yeah.
The next question is from the line of Chris Growe with Stifel. Please proceed with your questions.
Hi, good morning.
Hey, Chris.
Just had a question for you. As I think about the current state of your business, the current mobility, and the sort of sales that's creating in at least in measured channels that we can track, and I realize we're not going to get the full picture because of the very strong growth in e-commerce, but it would seem to suggest against the really easy comps of the prior year, some very strong sales momentum in the third quarter. You go against those really easy comps in those kind of April and May in particular from the prior year. I just want to get a sense of how to think about like the current rate of revenue. And again, in a world where you don't expect mobility to improve, should this general rate of sales hold based on your assumptions? And is any other considerations around that, like inventory movements, or we got a little bit of that just now from Jason's question, but also, promotional timing, things that could, distort it up or down in the coming quarters?
Yeah, probably helpful to think of it on a quarter basis. So historically, third quarter is a bigger quarter for us than fourth. So I would think, Chris, the kind of run rates you're seeing right now probably will be more like we'll see in the third quarter, kind of week to week. And then we would expect some softening because we do see it historically in the fourth quarter just based upon kind of the seasonality of the business. And then you rightfully pointed out that we saw higher levels of inventory in transit at the end of the second quarter, which obviously just flow right into the third quarter. So I think that's probably helpful from just how to think about run rate standpoint. And again, to Jason's question, we're assuming we learned a little bit about mobility, a little bit more specificity around mobility. And specifically, our brands correlate, in particular bars, and to a lesser degree, correlate not to just consumption, correlate not just to general mobility, but being at work and being in transit to work. So general mobility is a good benefit because it improves shopper traffic and in particular in mass, but we're really looking for people to get back to their normal lives and get back to work. And if you think about it, that makes a fair amount of sense. While we've been sitting at home, we are probably eating more meals and using our products less for meal replacement. When we start going back to work and in transit to work, fewer meal occasions, more products, in particular bars and shakes, used as a meal replacement and or a snack while I'm at work. So for us, mobility we understanding what mobility really means made us a little bit more cautious as we moved into the second half of the year, because it seems like mobility is going to get better, but we really need people to get back to work. And for us, that felt like fourth quarter, first quarter next year before at least the U.S. gets back to that state.
Okay, that's good color. Thank you.
One other thing I would say, just if you remember from last year when COVID hit in March, retailers really just kicked out or pulled off all their promotions. So we are lapping that now. We're kind of at a normalized promotional period for Q3 and also for Q4. So you're going to see, and if you remember last Q3, volume was way down, which was not helpful for us, obviously, but our margins, both at the gross margin and the EBITDA margin, really benefited from that pullback in trade activity. So the profit held very, very nicely. We're going to see a bit of a reversal of that in Q3. I think we're going to have a very strong volume quarter as we lap Q3. We're also reinstating some trade, so that will have a bit of a margin hit for the quarter. And then as you go into Q4, as we started to, especially on the Quest side, Quest had a very strong Q4. They snapped back very, very quickly, and we had pretty normal trade activity in the quarter, and so the trade impact should be pretty nominal in Q4, but there will be a Q3 impact.
Okay, that's good color. Thank you. And just a quick follow-up, because it kind of leads into the point you made there, Todd, around promotional spending. And then I guess so. I think what you just said is we should look for, I guess, like more normalized promotional levels for the second half of the year. And I just also was curious around that, if the degree to which incremental shelf space, the innovation, if that's prompting even more, therefore, than what's called the normalized level of promotion.
I don't think so. It's again, it was just really artificially low last year. So we're going to go back to normal levels, and then just unfortunately year over year, it looks like there's incremental trade spend, but it's really just getting back to kind of 2019 levels.
Okay. Thank you for your time.
Thank you.
Good day, Chris.
Our next question is from the line of Faiza Alwy with Deutsche Bank. Please proceed with your question.
Yes. Hi. Good morning. So my first question is, around Atkins. I think we all know that there are two drivers that have impacted Atkins. One is maybe, the weight management side of things, and the other is just, reduced consumer mobility, as you talked about. And I'm wondering how you think about those two drivers, because you mentioned, renewed consumer interest in weight management, and then you mentioned sort of, return to work as two main components of, bringing Atkins back to more normal levels. So we'd just love more perspective around how you think about those two drivers going forward.
Yeah, well, great question. First, if you just track what's happened since COVID, third and fourth quarter on Atkins, we saw a dramatic fall off in people coming to the brand. So our new buyer growth post-COVID through the end of our fiscal year was down dramatically, down double digits. And that impacted, obviously, total volume in the second half of the fiscal year on Atkins. Encouragingly, starting in September and going through the second quarter, we've seen buyer flow, new buyers coming in, and loyalty among retained buyers at historic levels. So people started coming back to the brand and coming back to weight management pretty much timed with the beginning of our fiscal year. That's encouraging. That means interest in weight management, interest in the brand has been strong since the start of our fiscal year. So we feel pretty good that our marketing is working, our product innovation is working. And so the gap in volume on Atkins, if you think of it from a buyer standpoint, is just straight out buy rate. So how much people are consuming, and then that led us to a path of trying to understand what the driver of that is. And what we learned is there's a high correlation in bars and shakes on Atkins and bars on Quest around being at work and being in transit. Fascinating, right? So what's driving Atkins' performance is not people's interest in weight management. It's flat out the number of occasions, kind of where I am, and how much I snack, right? How much I'm using it as a meal replacement. And as I mentioned earlier, when I'm home, I'm eating more meals, and I'm using snack foods less as a meal replacement, right? And I might even snack less because I'm eating more regular meals because I'm home. As I start getting back and going back to work and taking the kids to school and going to sports, convenience becomes more important. My snacking behavior goes up, and I'm probably using our products more as a meal replacement. And you can see that by form. Bars and shakes, which tend to be more meal replacement oriented than snacking oriented, doing less well as people have not been at work and in transit. And then what we call the snackier portion of our portfolio, so chips and cookies and confections, they had no correlation whatsoever to location. So, they are getting consumed at normal rates, and we would not expect any change in those forms as people return to work and return to their jobs and kids go back to school. So, for us, very encouraging. Consumers are coming back to the brand, and as they get back to work, we're going to see buy rates go back. We're pretty confident of that.
Okay, that's super helpful. Joe, I was wondering if